Hey everyone, welcome back to Crypto Philly, where crypto meets compliance, clarity, and maybe even a little bit of chaos. I'm your host, Sean, from CoinFlask, your go-to tax advisor for all things on-chain. In today's episode, we are going global. We will be diving into crypto taxation in different countries, and then doing a quick analysis to determine what would make more sense. Because let's face it, not every government sees your NFT flipping or DeFi yield farming the same way. Whether you're a nomadic crypto bro or just wondering if Portugal really is a tax haven, this one's for you. So, why do we even care about how different countries tax crypto? Well, in the event that you forgot, crypto is borderless. That is what it was made for. It's one of its primary functions. But taxes are not. So, where you live, or even where you are deemed to live, can change your tax bill from zero to shit, I need to sell half of my holdings. Let's break down a few global hotspots. We're going to start it off at home here in the United States, where the IRS wants it all. Yep. In the US, crypto is taxed like property, meaning capital gains apply when you sell, trade, or use it. You also have to report every transaction, including airdrops, staking, mining, and even using crypto to buy a cup of coffee. So the United States requires you to be highly compliant. Okay. That means high compliance burden, high audit risk, and high stress. Plus, failure to report, yeah, that could lead to penalties or even criminal charges. Now, let's go over to Germany, where time rewards the patient. That's right. In Germany, crypto, which is held over for 1 year, is 100% tax free, regardless of the gain. But if you sell it before that, you will owe taxes, but only if the profit exceeds 600 euros. So in Germany, holding isn't just a meme, it's a tax strategy. Going to one of its neighbors, Portugal, also considered to be a European paradise, mostly. Well, Portugal was famous for not taxing individual crypto gains, especially for casual traders. But back in 23, they introduced a new tax law where if you sell crypto held for less than 1 year, it will be taxed at 28%. So I guess it's not the paradise it once was, but hell, it's still pretty crypto friendly overall. Going down to Southeast Asia, to Singapore. In Singapore, there's really not too much interference from the government or regulators. Singapore treats crypto as not taxable if it's a capital gain, which is most cases for personal use. In other words, if you're just trading crypto for your personal benefit and it's a personal asset of yours, it's most likely not going to be taxable. However, if it's involved in business dealings, then that's a different story. And income tax applies. However, for retail investors, it's one of the most favorable regimes out there. Now, going down to Australia, it has more clarity, but in many ways it's similar to the US. Australia follows the capital gains model too, just like we do. Every sale, trade, or use of crypto is a taxable event. The Australian Tax Office is also very active in compliance outreach, even going as far as sending letters to crypto users. What's the bright side to that? Well, they offer more transparency and they have clear guidance than the IRS does here. Now let's go down over or back up to India. Now these guys, they have a brutal, brutal flat tax rate. What I mean by that is India applies a 30% flat tax on all crypto gains, and it doesn't offer any loss offsetting like some of the other countries we just mentioned. That's right. Even if you lost money on one trade, you're still going to owe almost 30% or more on the winners. Sorry, not more. It's a flat tax. So it's going to be 30% flat on the winners. Oh, and they take 1% tax deducted at source on every transaction, also known as TDS. What that means is every transaction that occurs, they will tax it 1%. So not only are you doing the 30% flat tax, but now you have the additional 1% for every single transaction you do. So imagine having thousands upon thousands of transactions on line items that you have to go through. Eventually that 1% begins to add up. Now, damn, that's rough. All right, so let's do a quick comparative analysis here. Now we're going to list out the countries, and we're going to use the following criteria to determine whether or not it is favorable or not. Long-term friendliness, criteria 1. Criteria 2, capital gains tax. Criteria 3, is there a loss offset allowed? And the last criteria, is it retail friendly? In the United States, it is not friendly in the long term. There's capital gains taxes up to 37%. There are loss offsets allowed, but it isn't that retail friendly. Germany, friendly in the long term, especially after 1 year. There are capital gains, but only if you sell less than a year. They do allow offsetting of losses, and it is retail friendly. Portugal, same thing as Germany. After 1 year, it is very friendly in the long term. In the short term, however, there is a 28% capital gains tax. There is offsetting allowed, and it is retail friendly. Singapore, definitely friendly in the long term. For capital gains tax, none if it's personal. Yes, if it is related to business. So because there is no capital gains tax when trading personally, there's really no point of doing a loss offset. And for retail friendliness, Singapore gets 2 check marks. Oh yeah, they get a double whammy there because, wow, they are extremely, extremely friendly to the retail investors. Australia, not friendly in the long term. There are capital gains. They do allow offsetting losses, and it is retail friendly. India, not long-term friendly. 30% flat rate on the capital gains. But let's not just forget about the 1% on every single transaction that occurs. That's just insane, by the way. They do not allow any offsetting of losses, and they are not retail friendly. So just by that analysis, India would not be one of the countries to do long-term tax planning in. But the others, that's whatever, up to you, depending on whatever your personal situation is. Now, some strategical tips here. Location does matter. So if you're a crypto investor with flexibility or tax residency planning, can make a massive difference. Hodling or holding smart in countries like Germany or Portugal, where holding for 12 months can save you thousands, by the way, would be an ideal move. Third, staying compliant no matter where you go, though. Keep your record straight. Use tools like CoinTracker or Coinly to automate your reporting. Also, remember to think beyond your gains. You're still going to be getting taxed on staking rewards, interest, mining, and NFTs. But just remember that they all might be treated different, even within the same country. So just because you're thinking about gains doesn't necessarily mean the other activities you're doing within crypto, Web3, DeFi, whatever, are going to be treated the same. So make sure you read up and are fully knowledgeable about the country you are doing your tax planning in. So for my final thoughts, so is there a perfect place to be a crypto investor? My opinion, no. Every country has its own nuances, but with smart planning and a bit of guidance, you can make the system work for you, not against you. All right? Anyway, that wraps it up for this episode. So if you enjoyed this breakdown, don't forget to subscribe to our podcast and our blog. And if you need help navigating this crazy tax world, you know where to find me. CoinFlask. Or go to our website, cryptophilly.com. Until next time, keep stacking, keep strategizing, and always stay compliant.